Yeah, today we're going to talk about real estate cycles. It really impacts how you finance your building and what choices you make depending on where we are in the cycle.
Welcome to The Landscape, the new GSP podcast. We're excited you're here. You can find The Landscape on Spotify, iTunes, and other platforms that carry podcasts. I'm here with David Pascal.
Hello.
My co-host, and our special guest today is Bryan Shaffer, Managing Director and Partner here at George Smith Partners. And I'll let Bryan introduce the topic for today.
Yeah, today we're going to talk about real estate cycles. It really impacts how you finance your building and what choices you make depending on where we are in the cycle. And the Fed just said today that they don't think inflation normalizes until 2025. So it's really important for people to understand real estate cycles and how to survive them, because what I found over the last 30 some years is the companies that survive one or two cycles go on to prosper, but a lot of companies get wiped out in the negative part of the cycle.
Great. Sounds important, relevant to our audience.
Mm-hmm.
We, here at George Smith Partners, obviously we're in the game of financing commercial real estate, and so we see a wide swath of clients that come through. So let's open it up. David, you want to hit Bryan here with the first question?
I'll ask this, Bryan. When do you think we'll see a little more? When do you think transaction volume will pick up? Right now, I think we're going through a period in the commercial real estate market of price discovery. What do you see on that?
It's an interesting question. I have a lot of clients that are out purchasing stuff, and there's deals here in Los Angeles that we're selling. Let's look at multifamily that were, say, $350 a unit a year ago, and some of those deals are trading for $250 a unit today. So there is some movement in the market, but it's not widespread. And there was a deal that some of my clients looked at in Houston that was a foreclosure by a lender on a Fannie Mae deal, and basically everybody thought there's all these funds out there, they're going to jump on it, but really one of the mezz players inside the deal took it over before it hit any of the public forums, before anybody could market it, and they brought in new cash and took over the deal, kicked out the sponsor. So really what we're seeing is there's still enough capital on the sidelines for the distress that's out there to absorb it, and there are deals happening, but it's not widespread. So we're not seeing widespread price reductions. I can't show you any examples of any markets where we're seeing major drops in value, but we're starting to see on the outskirts, the guys that weren't good operators, that probably shouldn't have been in those deals to begin with, are having trouble. We are seeing more activity on the construction side, and on that side, people are selling deals, and lenders are trying to sell their notes on a lot of deals because they got in and now they're upside down in the construction. But on real cash flowing assets, it's hard to see when the discovery is going to happen. My guess is mid next year.
So let me ask a question specific to this. I think what you're saying is, yes, there's a tremendous amount of capital on the sidelines, but at present, many of the distressed deals are being handled by close to the best parties or internal parties. And so
it's not hitting the market yet. There's not any market for distressed properties. Nobody's getting at those assets and getting a lot of money out for distress. It's just there's deals happening on the sidelines where one or two deals were going the wrong direction, and you have that in any market, but you're seeing more of it now. Like a year ago, if you were selling these same properties, you'd be $50,000 to $100,000 higher, even if they were per unit, even if they were not distressed. At least that's what we're seeing in the market, or I'm seeing in the market.
Okay.
I think another thing we're seeing is it's getting very product type specific. I mean, obviously there's the office overhang, and we'll discuss that. But right now we're seeing buyers for Class B apartments, well performing, grocery anchored retail, industrial in the supply chain, are possibly overpaying a little bit of flight to quality. And the riskier assets right now are going to be the not so good retail, the big box retail, office. And so we're kind of getting into a, not a bifurcated state, but we're going to have maybe two types of buyers: people preserving capital, flight to quality on the things I said, and then the risk takers really looking for that basis drop on troubled assets, which
No.
hasn't happened yet.
Yeah, it hasn't happened yet, and it's interesting because there's a lot of people that were entering the private lending space hoping to capitalize on that big drop, and I haven't seen them really be able to get money out on those deals either. But at the same time, on office, it is extraordinarily difficult to get. There's a few, CMBS and bond lenders that are lending on it, but it's really tough to get a loan on office, period. So not only do you not have that many buyers or the pool's different, but you just don't have any capital on the
You have a
lending side.
liquidity issue, on the lending side. And with the recent distress in banks, we're seeing a lot of the shadow banking lenders come out. And I think what's really been significant was the recent sale of the Pac Western loan portfolio to Kennedy Wilson.
Yeah.
And you are seeing, the shadow banking, unregulated funds taking over lending. Now, that is taking a space away from what was the regional banks that are now in trouble, but it's not going to be so simple because regional banks always had access to the Fed's ultra low cost of money, except when Powell puts the brakes on. But the shadow banks, like the debt funds, they don't have access to the Fed window. So ironically, they're going to be reliant on bank lines, but perhaps those banks will be better secured and lower leverage, and also doing the business that they should be doing, which is lending very short floating and not lending fixed and longer. And so I don't know if it's a magic bullet or not, but we're seeing that.
Yeah, no, it's interesting. And what we found in cycle after cycle is the guys that are able to do that and buy those bank loans at some discount have been able to prosper for those long term. I mean, it gets back to what we were saying, like each cycle is really a holding cycle. Like I worked for the RTC when I was 22 years old. And that was predecessor to sort of the FDIC and taking over all these savings and loans. And what we found is at the very end of the cycle, the RTC securitized all the bad assets. They had put all the bad ones in one section, and these were the ones they were never going to make any money from. And sure enough, they securitized them, held them for 10 years, and the federal government made a profit off of those loans. So I mean, I think that what Kennedy Wilson is seeing and these debt funds will be able to do is if they can hold on, if they can stay financed well enough themselves, that they can prosper in the future, because these assets will go up in value. But it's all about the cycle.
The staying power.
The staying power.
Right, and I think that's where office is diverging, because many other property types are just going to go up and down with the economy.
Yeah.
But office might get left behind because there's been a secular shift in American workers. We don't need to go into that in detail right now. But so that's kind of the wild card here.
Yeah, no, for sure. It's going to be really interesting to see how it all plays out. And each cycle is always different, but it is all about staying power at the end. And, maybe we should say stay till 25, but
Right.
it's really about trying to stay and have that money and make the right decisions today so you have enough money. Like I sometimes have clients, say, they want 8%. I'm not going to refinance this deal and pull out $10 million. And then 3 months later, they have huge problems because they don't have that $10 million. So, I mean, I think it's really important for people to think about the cycle and do anything possible to add to their staying power, even if it's a little bit more expensive than they want to pay.
Yeah. Okay.
And, and we're looking at this chart, maybe we'll put it up. This is maturing U.S. property loans. This has been highly publicized, Bryan. We've got the 1.5 trillion of maturities from now until the end of 2025. But what's interesting here is 26 and 27 are still huge, huge volume, which shows that we're in a cycle of 3 to 5 year loans right now, maybe 7 to 10 year loans going back. And these are all hitting this wall. And who's going to take these out is, we know that lenders, especially banks, are reluctant to take over properties because they're not set up to do that. How do you see I know you won't have all the answers, but how are banks, give us like, because you had all the experience in the RTC and at your previous employer. What do you see the banks doing here? They can't kick the can. Tell me.
I think a lot of times they're just going to stay on the sidelines and try and, sort of stay alive as well. And they're trying not to make big moves. They're trying not to put new money into commercial real estate. And what they're really trying to do is just hold their portfolio, figure out ways that they could keep lending and try and edge up the amount that they're getting in on their investments, because a lot of them have huge chunks of their portfolio are locked in for the next 2 or 3 years at 3.5%, 4%. And market rates are substantially higher than that, and their borrowers are starting to want more money to leave deposits there. And so it really does mean tough times for some of these banks, especially the smaller regional banks. We're hoping that the bigger banks, the Chases of the world and the Wells Fargos step in, because they are well capitalized and they do have lending power, but they've chosen not to be super active on the commercial real estate side this cycle. But I think it's interesting with everything coming in, because as we look at refinances, and I'm sure both of you guys are seeing this, is that most refinances today are cash neutral or cash in.
Right.
There's very few cash out transactions. So you look at this wall of loans that were made 5 or 10 years ago, they're all going to be either cash neutral or cash in, and most of them are going to be cash in. And people are going to be left with that decision that they make every cycle. Do I put money into this property that's at or below value, or do I walk away? And it'll be interesting to see what people decide.
What's ironic there is probably when these loans were made, there was a nice little cash
Right.
out.
Yeah.
But that money's been spent.
Exactly.
Yeah.
And these were like 2015 was one of my best years here at GSP, and
Me
there were
too.
a ton of loans done in that year. Because we were, 2013, 14, we were sort of gapping up.
Right.
2015, that confidence was coming back, that
Right. The
we were in a
animal
strong
instinct,
recovery, and we really grew strong until 2018, and then 2019 was, I think, the company's best year ever, and then COVID and all the other things happened.
So let's talk a little bit about the capital available. We touched on it earlier, but let's put this into like the terms of our clients. Our clients are generally commercial real estate sponsors. So if you're a commercial real estate sponsor, let's talk about some advice specific to that. We're seeing a lot of transactions and deal flow. A lot of folks with maturing loans, or there's a lot of folks with construction projects that cost more than they expected due to interest rate increases through COVID, et cetera. So, let's talk about capital availability, what we're seeing people do to shore themselves up, to give themselves the staying power. I don't know, Dave, if you want to take the first part of that.
I'll take it. I think this is really going to get down to, not just the sector of lenders, but lender by lender, market by market. Meaning, what is the lender's exposure now? Are they overexposed in office, and maybe another lender in the same field did a bunch of industrial loans? I'm just trying to, from a 30,000 foot. And that industrial, the lender who lent on industrial, who's getting payoffs, et cetera, is going to have fresh powder and might want to lend even on an office at the new basis. And so, we might have this, this bifurcation of lenders, as it all depends on what's in their portfolio now. On CMBS, I think there's an interesting story here. I think that we've now kind of went through this office purge that at least where office is now changing. We're gonna have to change a little bit of that, but I'll start again. On CMBS, I think we might have an interesting market approaching. There's a CMBS 3.0 or 4.0, whatever we're in now, means only 20% of any pool can have office in it. And bond buyers are pretty happy with that in recent months, because they know they're only getting the best low leverage office. And then the rest of it, industrial, self-storage, apartments, good retail, a lot of it. And so, so there still might be pools and CMBS lending that might restart again. Meanwhile, though, you're going to have distress amongst the old pools that were originated in 2013 to 2015 with a ton of office and retail in them. But the lender today, and that's the beauty of CMBS, or the curse of CMBS, is the lenders aren't affected because that's going to be handled by bond buyers and servicers.
Yep.
So, we might see.
But again, pull
some
that back
of
pull that back to our clients. Like,
Yeah.
what does that mean for me as a real estate sponsor?
What it means is, I would say is you need to thoroughly investigate each sector. Like, you need to understand what CMBS will do, what banks will do, what debt funds will do right now, and have a good capital advisor, if I may plug our services right here, that is talking to these lenders every day, knows what's being sold, what's being paid off, and who has fresh powder and for what product type.
And I would add to that, I think it's really important, and you're right, David. I mean, individual doesn't have the ability to go out and do all these things. They're not in the market every day like we are. But the other thing that's really important is that they focus in on what's available and what will work at that time, and they do it because we don't know what's going to be available tomorrow. So if the CMBS market is doing loans and you can get a loan down on your property that works, I would highly recommend you get it done and close, because what we find is people delay. I don't want to pay 7.5% for a perm loan. I'm going to wait, and then all of a sudden that becomes 9%, and they can't do anything, and they lose the property. So I think timing is really important.
Allocations, and people have capital raised into funds, and what I think people are recognizing is that there's not necessarily, like you talked about at the beginning, a giant wall of distress to capture that capital right now. And so we are seeing, at least I don't know if you guys corroborate this, but
yeah, I feel the same way. And I also feel like there's some lenders, like when we were at the Mortgage Banking Association meeting in February, a lot of groups were announcing they're going to start making construction loans, and those groups are now coming online. So there's probably a 3-month lag from them announcing they're doing it to actually doing it. But there's a lot of brand new groups that are coming in and lending, and they don't have the legacy problems that a lot of the guys had that
fresh
started. Yeah. You think of a lender that, is taking lines from a bank, and that lender was lending at when LIBOR was 25 basis points, or SOFR was 25 basis points, and now it's at 4 or 5%. Like that's a huge gap on them, and they have to fund in money to their line lenders. And so,
interesting, David.
Yeah, and then and other types of lenders, life companies have huge allocations, but they're just being very conservative right now. And so there's money out there, but it's how it's priced and how much. And we're not in a liquidity crisis like 08, 09, where there was just no money. Now it's just how it's priced,
right?
And the limits of a certain property, meaning its exit cap rate or cap rate today.
Great. Anything else?
No, I think
parting words as we kind of wrap up here.
Yeah, I think what I would tell people is just be cautious, but realize that if you want to get a deal done, you've got to take what's available in the marketplace. And I think that's what we're sort of all saying, is that the ideal isn't out there today, but there's still the right structure to make a deal work if you have the right advice and the right people working for you.
Got it. Well, we will be recording these at least once a month and putting them out there for all of you. Please sign up for our FinFacts newsletter. We have thousands of people across the country that read that. Go to our website, you can sign up there.
And if you want to suggest a topic for a future podcast or ask a question, let us know.
Let us know. Hit us up on email or LinkedIn. You can find us at gspartners.com. We'll put the link in the show notes below. We're also distributed on a number of platforms. Those will be in the show notes below. Finally, sign up for FinFacts. That's our weekly newsletter. It has amazing articles and tidbits on a variety of topics across the market. You can sign up for FinFacts at www.gspartners.com. Reach out to any of us on our emails. Those are on our website and available. If you want to talk about certain things on the podcast, you can hit me up, at least on LinkedIn and Twitter.
Me too.
Yep.
Me three.
Okay. All of us. Good.